The ATO named income splitting as one of their 7 compliance targets for 2026, and they've released a practical compliance guide specifically designed to enforce the personal services income rules, with heightened scrutiny starting this financial year. If you pay your spouse through your business, whether it's a salary, a trust distribution, or a director's fee, this is directly aimed at you. So I want to show you exactly what the ATO is looking for, the 3 specific arrangements they're targeting, and what you need to do about it right now to make sure yours is bulletproof. Let's start with why this became so common in the first place. Because it wasn't some dodgy loophole. It was genuinely smart tax planning. Say you're running a business making $300,000 in profit. If all of that comes to you personally, you're paying close to $107,000 in tax. But if you can split that, pay $150,000 to yourself and $150,000 to your spouse, the household tax bill drops significantly. You could save $30,000 to $40,000 a year just by having 2 people in lower brackets instead of 1 person in the top tax bracket. Accountants have been recommending this for decades, and for good reason. It's legal, it's effective, and for years, the ATO barely questioned it. Your accountant set it up, your spouse went on the books, and nobody looked at it again. But the ATO's view has always been that if you're the one doing the work, they want to see the income assessed to you. That position was established in the courts through a number of cases in the 1980s. There's no specific law that says all the income has to go to you. Instead, the ATO says they'll apply general anti-avoidance measures called R4A, which they used successfully in those 1980s cases. So some accountants let their clients split income anyway, seeing it as low risk that the ATO would actually do anything about it. And that's the bit that's changed. The ATO's 2026 compliance targets explicitly call out income splitting. I covered this in my ATO radar video earlier this year. They're specifically looking for substantial distributions to associated lower tax persons. In plain English, if your spouse is on the payroll and isn't doing the work, that's on their radar. But before I get into the specifics of what they're targeting and how, there's a concept you need to understand because it determines whether your business structure can actually do what you think it's doing. The ATO splits all income into 2 buckets. First, you've got income from assets, rent from property, interest on cash, dividends from shares, revenue from selling stock or hiring out equipment, and the income from a business structure such as where you employ people or intellectual property. That's the first type of income. The second type is where you've got income from personal exertion. If the money you're earning comes from your skills, expertise, your effort, that's personal exertion income. And that's where many service-based business owners get caught out. Within personal exertion income, there are 2 scenarios. The first is PSI, personal services income. This is where you don't pass any of the 4 PSI tests: the results test, the unrelated clients test, the employment test, and the business premises test. If you fail these tests, the law automatically attributes that income to you as an individual. Your company or your trust becomes irrelevant. The income gets pulled straight through to your personal tax return. There's no discretion, no argument. It's automatic by law. The second scenario is where you pass at least one of those tests. Now you're classified as a PSB, a personal service business. You're legitimately running your business through an entity, and this is where the confusion lives. Because most people assume that passing the test means they're free to split their income with their spouse or retain profits at the company 25% tax rate. They're not. And they never have been. That's the position from those 1980s cases I mentioned earlier. But because enforcement was patchy for so long, people got comfortable. I see this all the time. People come to me from YouTube, I look at their setup, and it's immediately obvious they're offside. So that's the context for the compliance guidelines the ATO released in late November 2025. This PCG is aimed specifically at personal services businesses. And the message from the ATO is straightforward. We know people have been doing the wrong thing and we're done looking the other way. You've got a window to fix it, and after that, we're coming. I always think of these PCGs like swimming between the flags of the beach. If you stay between the flags, you're in the safe zone. The ATO will leave you alone. If you're out past the flags where the rip is, we've now got the lifeguard on the megaphone at Bondi telling you to get back. And if you don't move, they're sending out the jet ski. The guideline characterizes arrangements into low risk and high risk. If yours sits in the low risk, the ATO says they'll leave you alone. If it sits in the high risk zone, you're in line for a review. And the high risk indicators are exactly what you'd expect. Income being split amongst family members at the lower tax rates. The person who actually did the work being paid below market value, and profits sitting in an entity with no genuine business reason for keeping them there. The other thing to keep in mind is that having a legitimate business structure doesn't protect you on its own anymore. For years, the advice from some accountants has been if your entity passes the business test, you're fine. The ATO has now made it clear that even if your business is set up properly, they still will intervene if they believe the structure is being used to split income in a way that doesn't match what's actually happening in the business. And this applies more broadly than you think. The ATO's own examples in the guidelines include doctors, IT consultants, and in one specific case, a licensed electrician. So this covers tradies, not just white-collar workers. If you're in a service-based business where your income comes from your personal skills and effort, this applies to you. Thankfully, the ATO have given a transition window. Now, we wouldn't let our clients do this in the first place, and we never have. But I've had clients leave us and go to another accountant who did let them split the income this way, and they've left because of it. So although we've got a clean slate, there are plenty of business owners out there who don't. I see it regularly though through YouTube inquiries. People book a call and I look at their setup and I have to tell them that there's a problem. I had one husband and wife recently, both full-time IT professionals with a side business they run through a company. They'd retained $500,000 in that company after paying the 25% tax rate. The cash just sitting there in the company bank account. I had to tell them that the ATO's view is that they should be paying tax on that $500,000 at their marginal tax rate, not the 25% company tax rate. If you're in a similar position right now, the ATO has said that you have until 30 June 2027 to move into a low risk arrangement. If you make a genuine attempt to fix it before that date, they've said they won't come after your past arrangements. On top of that enforcement side, there's a bigger structural shift that just landed. The federal budget confirmed a 30% minimum tax rate on discretionary trust income, effective 1 July 2028. The trustee pays the 30% tax up front, and the individual beneficiaries receive a non-refundable tax credit for what's already been paid. If you're distributing to a spouse or family member on a lower tax rate, the days of that income being taxed at their marginal tax rate are over. The minimum is 30% regardless. So basically, trusts are now under pressure from the ATO on enforcement and from the government legislation. And for the first time, there's a funded pathway to move out of them. So the question the ATO is now asking, and the question you need to be able to answer, is simple. Is the person doing the real work? Is the pay commensurate with that work? Would you pay a stranger for the same amount in that role? And can you prove it? Those 4 questions sound simple enough, but the answer depends on how you're actually paying your spouse, because the ATO treats it very differently depending on your structure, and each one carries different consequences. So let me walk you through 3 arrangements they're specifically targeting. The first is trust distributions. This is where you're distributing income to a family member through a family trust, and they have little or no genuine involvement in the business. The ATO's test under Section 100A is whether the money genuinely ends up with that person you distribute it to for their benefit. Distributing to your spouse where the money goes into a joint account or gets used for household expenses is actually permitted because the spouse is receiving the benefit. When it becomes a problem is when you're distributing to someone like an adult child or a parent and the money doesn't actually end up with them. If the distribution shows up on the tax return, but the cash flows straight back into the business or gets redirected to pay for something that benefits you, the ATO can reclassify the entire distribution and tax the trustee at the top marginal tax rate, and they can go back for many, many years. Now, they obviously want to counter this by the new 30% tax rate that will apply at a minimum to trust income, and I think they're going to achieve it. The second is salary and wages. This is where your spouse is on the payroll as a bookkeeper, an admin assistant, or office manager. The ATO's test here is simple. Is this a genuine expense of running the business? If your spouse is being paid $80,000 for a role that involves 5 hours a week and you'd pay a stranger $25,000 or $30,000 for the same work, the ATO can disallow the deduction and reclassify the income back to you. The third is the personal service income rules. And this is the one that catches most people off guard. As I explained earlier, even if your business passes the PSI tests and you're classified as a personal service business, the ATO's position is that the income still belongs to you if it was generated by your personal skills and effort. So if you've been retaining profit in your company at 25% or distributing it to your spouse via a trust and the work was done by you, the ATO can reclassify all of that income back to you personally. You're then looking at back taxes, penalties, and interest on income you thought was legitimately structured. The threshold for getting clear of this is also higher than most people think. The ATO's rule of thumb is that you need at least one other full-time equivalent professional working in the business who is not a principal. If you're an accountant, you need another qualified accountant on staff. If you're an IT consultant, you need another IT consultant at the same level. And even then, the ATO still expects to see a fair level of remuneration going to you as the principal. You can't just hire someone and then route the remaining profit to your spouse. There's actually an entire PCG on this where the ATO have set levels on how much income they expect to see in the principal's name and how much tax they expect to see the principal's entire group paying. As I mentioned, the ATO's compliance guidelines make it clear that they're prepared to use their broadest anti-avoidance powers to enforce this, even if your business technically passes the standard tests. So at this point, you might be thinking, should I stop paying my spouse altogether? That's not what I'm saying. Paying your spouse through the business is completely legitimate if the role is real and the pay is market rate, and you need to document it. I've got a client with a trades business doing about $700,000 in revenue. His wife genuinely runs the operations side. She manages scheduling, supplier relationships, invoicing, and staff. She's got an employment contract and she's paid $95,000, which is what you'd pay an operations manager in that industry in Perth. She works documented hours and the money goes into her bank account. If the ATO reviewed that tomorrow, we'd welcome it because the arrangement looks exactly the same as it would if they hired a stranger. So if you're paying your spouse, that's what the arrangement needs to look like. If you haven't reviewed the arrangement in a while, now's the time to do it. If you want us to look at how you've got it set up and tell you whether it's solid or whether there could be gaps that the ATO could target, there's a link below to book a call with our team. And if you want the full breakdown of the latest changes announced by the federal budget, I'll link that video here.